In this section of John Murphy's technical analysis book, we want to talk about the different types of gaps. Stay with me. In the next section of John Murphy's technical analysis book, he discusses the different types of gaps. Just one thing you need to keep in mind here is that the types of gaps John Murphy discusses in this section do not include all types of gaps. For example, ordinary gaps, which also include CME gaps, are not covered in this part. In this section, he talks about 3 types of gaps, and we will review all 3 of them together here. The first type of gap that John Murphy discusses is the breakaway gap. So what is a breakaway gap? Imagine the way price moves in the market, sometimes moving up, sometimes moving down. You can see that somewhere along the way, a price gap forms, meaning part of your candlestick remains empty, as you can see in this section of the candlestick. This type of gap is called a breakaway gap. A breakaway gap occurs when you break through a resistance or support level or a trend line. So, where does it form? A breakaway gap usually happens when breaking a resistance or support line or a trend line, and it typically comes with high volume at the start of a trend. The volume is high, and the gap forms when resistance, support, or trend lines are broken. This is a sign of a significant price movement, meaning that the trend is likely to continue afterward. Usually, this type of gap should not be filled. If it does get filled, it indicates weakness, because when you have a major price move and the price is supposed to continue in the same direction, it shouldn't come back to that level again. Now, the next type of gap is one you'll see on this chart. Again, the price continues its movement, going up and down, and you see that suddenly another gap forms in the middle of the move. This type of gap that happens here is called a runaway gap or measuring gap. So it occurs in the middle of the trend, not at the beginning or the end. Its volume is usually moderate, not too low, not too high, and it indicates a healthy trend. In fact, it shows that the price is continuing its previous trend. It also acts as support or resistance, meaning that if the price returns to it later, it should continue its previous trend and the gap should not be filled. If the price fills it or even passes through it, that's not a good sign. It shows the price is reversing, and in that case, it's no longer considered a runaway gap. The next type of gap I'll introduce is one where the price should not return to it or break below it. You can even use it for setting targets. For example, you can measure from the start of the trend to the middle of the gap and expect the price to move up by the same amount again. So the runaway gap can also be used for target setting. But as the market continues, you see the price keeps moving in its trend, which in this case is upward, and you notice another gap forms at the top. The gap that forms here could be an exhaustion gap. So how can we tell if this is an exhaustion gap? Or it could be a runaway gap, which we have thoroughly discussed in the previous section. To accurately determine which specific type of gap it is, you essentially need to know 2 crucial things. The first important point to consider is that in a runaway gap, as we have previously discussed and explored before, the market volume tends to be moderate, exhibiting a steady and consistent level of trading activity. However, in stark contrast, in an exhaustion gap, the market volume is typically very high, indicating a significant surge in trading. In fact, the very last buyers who are still active in the market are desperately trying to push the price further up and create a final dramatic surge, which naturally results in an exceptionally high market volume. The second critical point that significantly helps us to precisely identify an exhaustion gap is that you will clearly see the price quickly and abruptly reverses its direction and then moves sharply and decisively downward. In other words, the price completely flips its direction. If it was initially going up, it now unequivocally goes down, or conversely, if it was originally going down, it now definitively goes up. The prevailing trend completely reverses its course. So an exhaustion gap is a specific situation where you observe a very high buying or selling volume, meaning the overall market volume is exceptionally high, and then the price quickly and dramatically reverses its direction, and the gap subsequently gets filled. If, during that significant reversal, you happen to see another gap form, as you can clearly observe here in this illustration, on the way back down, there is indeed another distinct gap. That particular formation can itself be another breakaway gap, indicating a strong continuation of the new trend. You can clearly see that on the way down, a breakaway gap forms precisely during the reversal move, confirming the strength of the new direction. In this specific situation at the very top of the chart where that significant event happened, you now clearly see the price reversing its direction and moving decisively downward. That particular area at the very top of the chart that you see formed is quite distinctive, resembling an island in the middle of the price action. There's a gap on one side and another gap on the other side, effectively isolating this price area. On the left side, there's an exhaustion gap signifying the end of the previous trend. And on the right side, there's a breakaway gap because on that side, the price suddenly and forcefully started moving sharply downward, initiating a new strong trend. So that's a clear example of a breakaway gap. That entire section at the top is commonly referred to as an island, specifically a price island, or sometimes more precisely, a candlestick island due to its visual appearance. If we now move to the next slide, you will clearly see that on John Murphy's actual real-world chart, he is meticulously showing you various illustrative examples of these different types of gaps. You can distinctly see the exhaustion gap positioned at the top left, the runaway gap located prominently in the middle, and again another exhaustion gap situated at the bottom right, providing comprehensive visual examples. Alright, and here again on this particular chart, you can clearly see that there are indeed two distinct gaps present on both the left and right sides. And then at the very top, what you unmistakably have is an isolated island formation. It's a price island that has formed up there for you. If you found this tutorial helpful, be sure to subscribe to the channel and hit the bell icon so you'll be notified as soon as a new tutorial is released. See you in the next sessions.